let me go ahead and ask this important question to all the panelists here. Why all roads lead to credit? We have been discussing credit because that has been an integral part between the NBFCs and FinTech these days. And the question that came to my mind, and we crafted this title specifically, is because all the payment companies or the FinTech companies who started as a wallet or got into the payment business ended up working as a creditor now, or ended up working in a credit segment. And all the financial institutions also believes that credit is the perhaps only way where they can make money, not the payment specifically after the MDR and all. So that's what we'll try to decode here, and I will also try my best to take at least 1 or 2 questions from the audience. So please be ready with a very sharp question here. And I will start with you Sanjay ji, first. Why all roads lead to credit according to you? I will ask this question to all of you 30 seconds as soon as possible. Yeah, please go ahead, Sanjay.
Thanks, Amol. And good afternoon, everyone, or good morning, because we haven't had lunch. But see, I think the answer is very simple. Credit and lending has always been a high margin business. Even in banks, if you look at their balance sheets, a lot of their profits come from lending. So lending is a good margin business. It's also a business where the number of loans given out or the level of penetration of the market is not very heavy. So it's obviously an attractive area for fintechs to look at, because with their use of technology and access to customers, they can originate more, get to areas where access has been sparse, and benefit from the margin that the product typically has. Thanks.
Sure. Nitin.
In my opinion, there are 2 reasons. The first reason is that if you look at different activities that you can do in financial services, right? Payments, lending, insurance, wealth. Payments and lending are the only 2 areas where it is not linked to the disposable income of a user, right? So irrespective of the disposable income that a user has, they need to do payments and they can consume credit products. So the profit pool is the largest and the number of users available there is the largest. The second reason is that among all these 4 asset classes, payments have been proven they don't make money. Among the other 3, the licenses are easiest to get in lending. You can get an NBFC license, but you can't get an insurance license. If you could get an insurance license, you'll realize it's also an interactive business. But as a startup, I don't think by any stretch of imagination, you can get an insurance license, but you definitely can get an NBFC license.
Sure, Nitin.
So it's not just with the fintechs, right? So it's with every other industry. For example, you see it as e-commerce, right? So there is a lending angle in the e-commerce where you can buy things on installments, logistics, right? So in some form or the other form where the lending is kind of coming in. So it's not very specific to fintechs alone, because this is one business, as everyone has spoken here, it just makes money, right? So this has been proven for thousands of years. I think lending is not a new concept, but the nature, the delivery and the offerings have changed on how the product itself is delivered to the customer. But as such, as an underlying business, I think this business has always made money, and that's the one of the biggest monetization chance for many of the companies. Now, just a second angle, while I agree to most of the things what has been said, but the other angle is also the customer behavior, right? So there is a good amount of shift in the consumer behavior. I mean, decades back, it was always the Indian customers used to be frugal about their spending nature, right? So it was always a savings mentality what the customers had. Today, the demography has kind of come to a very younger population. I mean, our median age is probably 30 years is the median age in the Indian population system, and then they are more kind of looking at spending, experimenting with a lot of product services that are available in the market, and they are looking for convenience where credit becomes one of the catalysts. So it's also driven by the consumer behavior shift, and lending is one of the great monetization tool for not just fintechs but many other industries as well.
Sure. Rajat?
Yeah, hi, good afternoon everybody. I'm Rajat Gandhi. Thank you for the question. So I think there are 2-3 aspects to the whole thing. Firstly, we have to distinguish between credit and lending. Okay, so I know you'll be surprised about it. Credit is anybody can give credit to anybody, like a Kirana store extends you credit for the 30 days when you buy groceries from him. It doesn't mean he's got into lending business, right? Lending is an act where you lend money based on data, whatever data it is, and then you have a collections piece to it. Okay. So yes, a lot of people want to get into credit. That's what the discussion point is. But are they really getting into lending? That's a debate which has to be understood. The other reason is that the lending business is one of the most profitable asset classes I came to know when I entered P2P lending, and is the best kept secret. Okay, that's the reason there are more laws which control the lenders than the borrowers in this country. There are some 25 laws which in the state lending acts, then there's the RBI, then there's everything out there. Having said that, the other big thing is the infrastructure business of within the lending and the payments, which is owned by NPCI or the government of India in our country. Whereas you have billion-dollar companies across the world in that infrastructure business. So for all practical purpose, the only business which is left is lending business from that perspective. And it's a very attractive business. So I think these are the various reasons which are things happening out there, which are pushing every startup to move towards lending.
Sure. Souparno.
Sure. Good afternoon and happy Friday. So to the question, I'll keep it simple. I guess it's about three things. Two things like catering to the demand side of it and one from the supply side of things. One is in terms of the overall economy, and in the earlier panel also the panelists mentioned about the economy is growing and therefore what it means both for asset-led consumption as well as like pure consumption, right? So that's one trigger definitely. But the nuance is happening at the second point of the demand. It's the consumer behavior which is driven by the velocity of consumption. I'll give you a simple example. Maybe when we grew up, at least I can say from my experience, it's not about the shirts which were bought for me. It's also about like whether it was just a Diwali or maybe a birthday. But today, just think about it. The velocity of consumption, the velocity of spend has gone maybe 20-25x. But the velocity of your income is possibly still a monthly salary. So that gap between what you're consuming and your income is actually an amplifying factor for credit and lending in credit in the retail space primarily. The third aspect is about the supply and therefore the serviceability of that market, both powered by technology and again thanks to the collaborative nature of the ecosystem, not just the banks but the NBFCs and how the supply from the funding side is getting fueled. That's also an endorsement that we call India as a creator economy, but somewhere it's more of a collaborative economy, and I guess these are the 3 points. Thank you.
Sure, Souparno. Saurabh?
Thanks, Amol. So I'd like to just add some context. First and foremost, today in India, there are over 450 lending fintechs that exist. So in that sense, yes, there seems to be this trend playing out where all roads do lead to credit. Secondly, if you look at where the money is going, right, and I'll talk about venture capital investments. Just in 2021, about $3.5 billion was raised by the Indian fintech space, of which about 1.5 billion went to lending fintechs versus 1.4 billion to digital payment fintechs. That happened pretty much for the first time, right? So the money is headed towards lending, which also means you'll see scale built there. Now, you can always ask, why are fintechs then starting as lending fintechs in the first place? And I feel that lending is this business where, number one, it's very easy to get customers, right? You can literally take a wad of cash and go on the street and you'll have hundreds of customers, right, in an hour. But it is also a very unique business which ends up saying no to its customers, right? At least some customers which are not eligible. So even if you're the 451st lending fintech that starts off in India, you'll always believe that there are these 450 entities which might say no to a certain customer segment, and I can drive inclusion there. I will do things differently, which is why startup founders gravitate towards lending. And also something that we spoke about earlier, the promise of profitability, the promise of margins, right? We've seen margins erode completely in digital payments. We've seen that not happen really with lending, right? Even if, for example, the cost of capital today is changing rapidly, even then you'll back yourself as a digital lender to still lend at very high rates because the loan itself is very short term. Right? So there is profitability, there is this belief that entrepreneurs can make money there, that's why VC capital flows there. And then something else that one panelist mentioned, the entire culture around credit has completely changed in the country. There is a lot more aspirational purchases. There is the embedding of credit in every transaction, which could have been served with cash or just a digital payment mode. So they are all drivers of credit. Credit demand is on the rise. So I feel that's the reason why all roads seem like they're headed towards lending.
Sure, Saurabh. I think a remarkable opening remarks from all the panelists here. And let me try my best to shift the gears and get more insights on this topic. So Sanjay, let me come back to you. And when I see that everybody is getting into the lending space because they believe the margins are better, they believe that India is a credit-hungry country, or they believe that the segment can grow, the big example is Vijay Mallya, or there are so many other people, who borrowed heavily but didn't manage to repay and they flied away. So we have these great case studies here. So my question to you, Sanjay, is, what are the pitfalls of lending? Because again, you are a little matured NBFC or a lender, but a lot of fintech companies actually lending left, right, and center. So what are the pitfalls do you see?
I think that's an excellent question, because the fact that credit is very attractive for everyone is known and has been known for many years. But doing credit and or lending and doing it at profitable levels needs a fair amount of skill. And whether we like it or not, everyone seems to think that bankers are quite conservative. They're not the smartest of people, but the fact is that they have worked with lending over the years and developed it into a fairly skilled process, skilled art, or an art form, you could say. Now, key challenges are that it's easy to give money, and yes, if you take a wad of money and go on the street, everyone will like to take some money from you, but collecting is where the challenge is. It's a business where you give a loan to or give money to a person with a promise that he will pay back. And how do you ensure that that promise is kept is the key. So I see this business as something where if you don't know how to get the collection in, you're going to be in deep trouble. And I think during the COVID times, a lot of fintechs who had rushed into this area have slowed down because they've seen huge losses. Because just saying that, I have a wonderful model for origination and I believe that my customers will pay on their own and digitally, often may not be there, and life is not that simple. So I think the challenge is in having a good collection method, collection mechanism, besides having good underwriting, good origination, and ability to get funds.
Sure, very valid points. Nitin, let me take your perspective specifically on the BNPL, because, and I give this example twice since morning because I was really impressed when FinTech told me that youngsters are even borrowing money to go on a date. So my immediate question was कि उसका breakup हो जाने के बाद loan कौन देगा? So the question is, what if people buy now but don't pay later? So what are the pros and cons of BNPL according to you, Nitin?
See, the biggest advantage of BNPL is that it's increasing affordability. That's the primary objective, right? What I would have bought 3 months from now, 6 months from now, 12 months from now, I can buy today and afford it today. And traditionally, it started with white goods, appliances, laptops, fridge, washing machines for the world. Then, because of two-factor authentication, it got into the realm of convenience. I don't want to enter a second factor. Let me buy food on Swiggy, Zomato, Ola Cabs, etc. Pay back every 15 days. And that was the second emergence. The truth of BNPL lies somewhere in between. Right? That's how it should be used. Now, the unfortunate thing is that a few years ago, many fintech entrepreneurs thought that traditional banks underwrite basis rules. We can underwrite basis data science models. And that's why they made this rush into opening fintech companies. The first wave happened around 2015-16, where everybody said, I have a superior underwriting model and I can lend. And this BNPL is great because I'm increasing affordability for the customer. What eventually followed was that people realized, and these are all first-time fintech entrepreneurs who went into lending, they realized that there's a difference between 1% loss rate and 4% loss rate. See, if you look at any lending business, right, they typically make 3 to 4% ROA. Now, if you have 1% loss rate versus 4% loss rate, that's where your profitability goes to zero. This appreciation dawned upon fintech entrepreneurs over the last few years, but it has dawned. And therefore, the way I see fintech entrepreneurs operating today, the way I see people building BNPL programs to make life more affordable as well as convenient for the customer, I see BNPLs now will do really well.
Okay. Sure, Nitin. Valid points. Madhu, there are different models, there are fintechs, or most of them operating as an originator or loan aggregator, but they have different formats in the lending itself. Somebody is giving only personal loans, somebody is looking at only salaried employees or something like that. So how do you see the growth specifically in the personal loan segment?
Yeah. So let me throw some numbers and then kind of come to that, right? So one is, barring that the pandemic time, the overall unsecured loans itself has grown almost at a 35% kind of a CAGR, right? So that basically gives an idea about how much potential this market has and how it can grow further as well. Now, there are a few interesting facts when we see this growth, right? So in last 5 years, if you look at the shift in the originations of these loans that has happened, at least in terms of the number of loan accounts, today the FinTechs NBFC combination holds the lion's share in terms of the number of loans that are given. I'm not exactly talking on the volume or the value of the loans, right? So 70% of the loans which are given as a personal loan today are from the NBFCs and the FinTech collaborations, right? So, but in terms of the volume of the loans or the value of the loans, still the banks hold the largest share there. Now, what does that mean is that the customer acceptance to the short-term loans, right? So, or the convenience, the BNPL, what we talked about, is in the form of the BNPL, or trying to get the products on an installment basis, or using the personal loan for an emergency need, or consumer durables or whatsoever, has increased its in size and in numbers, right? So going forward, I mean, just to put a number, everyone can argue on this. It's a $400 billion market, right? So, and compared to many of the other countries, I guess the GDP to credit ratios and all these things are pretty low in the Indian market, and there is a huge segment. Now, what is driving that, according to me, are 2 or 3 things. One is the overall, the demography of the population itself, right? So it's a pretty young working age population what we have got, and credit is one of the major catalysts for the middle class and the mid-income segment to kind of upgrade their lifestyles to the next level, and more of urbanization what we are seeing, especially the tier 2, tier 3 people who are living there or in the rural markets are today coming down to urban or semi-urban kind of a lifestyle. So this is the workforce what is getting added increasingly on a year-on-year basis. So when all these shifts in the paradigm is happening, then credit is the largest catalyst which will satisfy the increasing demand for the consumption, convenience, and the way of living today what we have got, and that's what we see even in terms of the numbers as well.
Oh, sure. So, Rajat, let me take a little different perspective from you. So, the personal loan or the loans under BNPL, the credit is available, or the loans are easily available. Obviously, we all would like to take a loan, don't want to prepay. That's a different story. But what about the stream of the liquidity? What about the stream of the funds? As a P2P lender, you have a different segment altogether from where you borrow, and but that is not the case with many other players. So what is the cheapest source of the capital for the NBFCs or the FinTechs, those are operating in lending space?
Quite a good question. So I'll tell you why we started this business. So I'm not a banker. For first 14 years of my life, I was doing something else. And we approached the whole problem from a perspective of the consumer rather than, we're not solving a banking problem as a P2P player. So when we saw that the people have a problem of getting credit, so there are 2 parts to the problem. One is the access to credit, second is the cost of credit. Okay. So a lot of fintechs are really doing work around access to credit. Okay, where they're making it very easy to lend, to receive money. Like app, you just fill up, you just click your selfie and your KYC is done quickly. Some is infrastructure work, some is the innovation they're doing. But the real disruption in any category happens when you do something faster and cheaper. So Ola and Uber did faster and cheaper. Okay, that you click a button and the car comes quickly and it's at a lower cost. Whether it was Amazon or, so a lot of work has to be done on the supply side for that. Okay, and when we visited, how do you make it cheaper? we said that who controls the money? So the whole money supply in this country is controlled by 247 banks. All your deposits go there. And that's where the money flow, the Ganga starts. And then the big NBFCs come, then the smaller NBFCs, then the FinTechs and everybody. So we said that why can't we go to that Ganga or the source of money or that is your money which is lying in the banks. And that's where the genesis of this business started. It's very early days. We've been into 4 or 5 years. And today I'm very happy to tell you that during COVID, when most of the lenders had stopped lending, because our supply was a different supply, or our Gangotri was a different Gangotri, as I would like to call it, we still had supply of capital. Even so, we were one of the few lenders in the country which was originating a brand new loan every day of the lockdown. When the first lockdown happened, we were originating new loans. Because our lenders didn't stop lending money. Their behavior was the same the way a stock market person was behaving. So this gave us a lot of confidence, and it validated our thesis that we don't have to be dependent on the overall monetary supply of the country. And all our growth has come during COVID. So we done more than 3,200 crores of loans. We don't advertise. We do 120 crores every month. I have nearly 200,000 lenders who are lending money on the platform. We've done more than 35 lakh loans. We do the 40,000. So numbers I'm trying to tell you, this is only my numbers. I'm not talking about industry. And it's happened only because we have an alternate supply of capital. And even today, when the interest rates have gone up, we don't have those issues because our notional capital is different. So I guess we need to look at different models on lending, and that's what we're trying to do.
Yeah, I think very valid points. And in fact, a lot of P2P lending companies have, two formats on their website. या तो आप पैसे देने वाले हो या पैसे लेने वाले हो. देने वाले हो तो आप 500 से भी ज़्यादा दे सकते हो और लेने वाला. I think that's a very interesting
so it's classical banking where the lender and borrower are mapped.
Yes.
So so when you put your money in an ICICI bank or HDFC bank, you don't know who the borrower is at the back end.
No, sure, valid points. So, Souparno, I would like you to tell us about the underserved or the untapped market of India and the credit opportunities that you or specifically the FinTechs can tap.
Sure. So Amol, even earlier in the day, right, it was called out on the panel, the underserved and underbanked is like 80%. And that's the fact of India. So if you see, therefore, from an opportunity and responsibility standpoint, that's a huge, huge market. I guess like we as a country and an ecosystem, we have done an awesome job to bridge the digital divide. But what we have an opportunity here to bridge the credit divide. And to your question in terms of like what it means in terms of the demand and how do you qualify the demand for the underserved, underbanked, trust me, it's not very different. At some level, I'm here today, but I cannot ignore the fact that I studied with a student loan. My quality of life got impacted because I could get a home loan or a car loan. The underserved is not possibly at that stage yet. So that's one layer of demand where we have an opportunity to cater to. The second layer of demand is a lot more deep, and that's about the non-discretionary need. That's about the need, I need money possibly in the next 1 hour to save life of a family member. Or I need money so that I can clear out my inventory for my small shop to run. So that part of the demand and the way possibly our responsibility toward that demand is possibly of a higher importance. So that's the way I'll qualify the overall sector, and this the two ways the demand should be triggering it.
Okay, sure. Saurabh, tell me something more about the partnerships model which the NBFCs and FinTechs are building on the basis of credit scores, on the basis of alternative data. I mean, every time you download some app, it asks for different permissions, and then you realize, oh, they're trying to develop the credit score for you. So how accurate the credit score is specifically that the NBFCs and FinTechs are developing, because everything is ultimately depending on that. If your credit score is right, perhaps your risk will be right, and perhaps you will get a better idea about recovery at the collection. So how, do you see that and your views on that?
Thanks, Amol. So you're right that credit information has a very important part to play. I won't necessarily limit it to credit score, but I will say credit information. If you look at the 2008 crisis, right, there were repercussions in India as well. There were some very large private banks that shut down their entire unsecured portfolio, right? And they'd been burned so badly that they took a good 5-6 years to come back. In that time, the others were opportunistic, and they're some of the most valued lenders today. Now, since 2008, what has happened is that when you look at unsecured lending, delinquencies are very, very low in India overall, right? Versus some other markets. Why is that so? Because lenders started embedding credit information and alternative data into all of their decisions. Of course, different trends and patterns have played out, right? You took the example earlier of Vijay Mallya. There was this entire buzz around social media scoring, right? If you were to score Vijay Mallya basis his online social media behaviors, I'm sure you'd see a lot of abroad travel and great affluent friends, right? But that didn't work out so well. What that means is that the fundamentals should never be challenged, right? Credit information or information which is going to reflect the behaviors or the actual affluence status of a consumer have a massive role to play. What's interesting is when digital lenders really started 2016 onwards, right? There were many different things that happened. Technologists came to the fore. Then they understood that, hey, you know what? Lending is still lending. The decades-old wisdom still has a place. And that's where credit information is where my assessment should start. Right? It is not just alternative data. It is not just app permissions, and that's not the only thing. Yes, they all are synergistic, right? So you need to cross-tab them, right? But I think extreme statements like only this works or only that works don't really work. The other thing I hear a lot from different lenders is they create all of these credit scores of their own, right? And do they perform? I'm sure they perform because those are tailor-made, those are purpose-built, which is why I said I won't comment more on credit score, but more on credit information. There's a reason I said that. Because the credit score itself is a very generic metric, right? It is supposed to perform well irrespective of what credit product is applied for. It works equally well for home loan versus personal loan. But if you want superior performance on personal loans, then you create a customized scorecard, which is attuned to the ticket sizes that you want to play in, the consumer segments you want to play in, the geographies you want to play in. And that's what the lender has the privilege of doing. As a bureau, we're serving the ecosystem, right? So we always have a generic ecosystem level score, which is the CIBIL score, just taking that example. But we also work with many fintech lenders, help them develop scorecards. And then, of course, the lenders also have massive access to device data, app data, right? Alternative data providers have also really scaled, right? This is something another panelist mentioned. It's not just that lending companies have grown, but the entities serving that ecosystem, the tech fins, have also really grown, right? Serving this. So, what it's led to is today the inclusion of about 420 million consumers who have ever taken formal credit. There is a massive opportunity in India. You can actually extend this to about 700 million. So there is a big new to credit opportunity for sure, right? But where fintech entrepreneurs have been very sophisticated and smart is they're not just chasing blindly the new to credit opportunity. Where there's material growth is actually not NTC, it is the near prime segment where 9%, which is the share of contribution of all originations, has gone to 36%, right? And that's sophisticated thinking. Why? Because they know larger banks will typically serve the prime, super prime customers. So they've been able to just feed slightly below that threshold. And again, credit information or any other alternative information allows you to tap into these opportunities with sophistication.
Okay, sure, Saurabh. So let me, bring in here audience. If anybody has any question, obviously I have a couple of questions left, and some 10 to 15 minutes. But before that, if anybody has any question to any panelist here, yes, please go ahead. Can we have the mic for the lady?
No, I was saying you can take your mic back.
I had a very important question about the credit parameters. NBFCs as well as FinTechs look at credit parameters
Okay, sure. May I know your name and the company? Okay, sure. Sanjay, do you want to take that question?
What I understand is that you're saying that how can NBFCs and FinTechs get to a scale of what banks are?
Not really to a scale of what banks are. Basically, credit parameters or lending parameters to the end customer.
Sure.
Credit is looked at very differently by NBFCs and credit is looked at very differently by FinTechs.
Sure.
How do you feel
Sure.
that, this
Right.
gap
Yeah.
is
I got the question. So the question is that how do FinTechs look at credit score or credit assessment versus NBFCs? See, it's important to understand that when you look at how credit has to be looked at, there's no rocket science, and if you believe that something seems to be too good to be true, then it is too good to be true. Fine. So if someone said that I look at only the social media scores and I can lend to anyone, now that I wouldn't probably agree with. But if it is for a specific set, type of customer segment, let's say, which are college-going children or college-going people, there the social pieces can be important. So first thing is that it's important to understand that what is the correct way of looking at a segment, right? And how do you, and if you are building a score, then the score has to reflect that. Now, to give you a very simple example, let's say if you're talking of on one side a long-tenured loan, like a housing loan, which is secured. Now, the way you would look at it is the stability of the person, the job, etc., and you have time to assess that. And it's a product where it's not the credit loss that's going to kill you; it's the operating margin, because the margin is going to be very slim. You will lend at 12% or 11%, and you have to make sure your cost to income is low. So, if you are assessing a housing loan, you have to look at a company that is very good at operating or automating its processes. On the other extreme, if I look at BNPL or a month-end loan, now remember that in a month-end loan, the tenor, because it is only 30 days or 60 days, one bad cycle will clean you out completely. Remember this, that it looks very good when it's growing. You may be growing at 100%, you may become a $500 million, etc. And I think there are stories in the US market where BN players have just fallen flat because of just one bad cycle.
That's right.
And one bad cycle is 30 days. So that has to be looked at. How does your process look at early warning signs? Can you detect a trend coming through? Can you take action beforehand? And to some extent, it's the same thing with the credit card industry, where early warning signs, velocity of transactions, how do you suss out fraud? Things are very different in the way you address them. And I think this example might tell you that FinTechs and NBFCs each have strengths that they bring onto the table. And I don't think none of them have all the strengths. So NBFCs can benefit from the use of technology, use of FinTech models, use of machine learning models, which help you in origination and in underwriting, and also in collection. FinTechs have to learn that lending is not only origination. It is about underwriting using sensible models, not just that it's a fad that I pick up everything from the phone and I know who's the good customer. And that's too good to be true.
That's true.
Then if I looked at someone's phone, I can't tell you that that how good a credit risk is he or she going to be. So I think to me that's the way I look at it.
The reason why I kind of asked this question.
As a FinTech, I should be allowed to speak to give the other viewpoint.
Can I come in?
Okay, quickly. Yeah.
So I'll tell you, there's a difference between the way we look at credit.
Yes.
So typically a banker or anybody who's giving credit sees from an exclusion point of view. How do I say no to this person, first of all? Okay. That's how the relationship starts with. Okay, why should I not give him loan? That's where you start, and then you start doing. And there's a history to it, because he has a cost of capital and he has to maintain his default rates to that region. Okay, because otherwise his cost of capital will go up, and thereafter he'll have to go to a riskier customer. So it's a chicken and egg situation which goes through. So we also went through that, but whereas our model is much more inclusive, because we don't have a cost of capital. It's the lender who has the cost of capital. So irrespective of my default rate, so I can actually lend between 12 and 24%. There are very few lenders who have that kind of range.
Right.
Right. So that's where the FinTechs are coming in and creating different models because of the supply of capital, how it is coming, plus the technology and the algorithms which they're using. I think that's where the difference is coming through.
Anyway, let me speak as a fintech here, and let me say something. See, as a fintechs, and let's not paint all fintechs with a single brush. The fintechs, which because of their superior models, the better analysis of data, through unique collection, access to data, by going deeper into understanding the customer segment and designing products around it, can do a better job. But NBFCs or even banks at the other end do not appreciate that difference today. And therefore, fintechs put skin in the game through this concept called first loss default guarantee, by saying, okay, you have a different point of view on credit parameters, I have a different point of view, I'll put in the skin in the game and prove that my point of view is right. Now, half of the fintechs get it wrong, but half of the fintechs do get it right. And that's my submission.
Sure.
FLDG, of
Great
course,
rejoinder.
Just that,
Trupti, I think we'll take that
yeah.
conversation a little later.
I'm sorry. I just want to make a point, right? So, your question has kind of taken a different, different way of asking us fintechs here.
It's not
three,
just
four.
fintechs.
No. I mean, I'm not totally against it because there was various points that came out in this particular panel, right? So, first thing was 3 years back I was asked one question: is fintechs are a bubble? This bubble is going to burst because you guys have not seen any cycles. There is shocks that are going to come out and whatnot. So there was definitely the major pandemic events like COVID wave 1, 2, 3 that happened. There was a GST event that happened. Today there is a inflation what's kind of hitting the market. So there are fintechs which have seen a lot of these cycles, and as it was kind of said here, that it's not that every fintech survived all these particular waves and events, but definitely there were more sustainable business models which were there among the fintechs. There were sane models that were built out, and they could come out of all these events very successfully and then still keep growing the way they were growing profitably as well, right? So there are many examples of that. Just that's one point. The form of the questions have changed, but at least these days people don't ask us that is it still a bubble that will burst sometime. So because we have seen many events and then we have grown from all those event cycles. Yes.
Sure. So, in fact, we have another panel about co-lending where we can discuss the parameters.
No,
Any other
maybe-
question here? Yeah. Please.
Hi, good afternoon. My name is Avinash and I work with the Rural FinTech. So all the information is being processed. Have been a banker, have been a credit rating representative, and have worked as a credit information representative in the past. A live case, very humbly to Madhusudan. I was traveling to one industrial town just a fortnight back, and I saw, which filled me with a lot of pride, joy, happiness, everything. I saw a scooter guy with a canopy attached to it and written KreditBee. And I couldn't stop, and while my cab was going forward, I was looking backward. So a couple of questions. Very happy, Mr. Gandhi, you touched upon inclusive part. Are we really defining as fintechs and startups, now I'm from that society, are we really defining and redefining inclusive lending or rural inclusion or inclusive financing? One. Second, I think that was more to do with the psychological study when you put a canopy by the side of a state highway. That is second. Third, what kind of information you process before saying yes to a passerby? Madhusudan, humbly to you. Thank you.
Thank you. And thanks that you have seen our ads here and there. So I keep asking our marketing guys that where are our ads, and then we are spending a lot. Oh, sure. Person. Okay, got it. Sorry. So anyways, right. So one is that the fintechs in general cater to different segments of people. There are fintechs which are majorly catering to the salaried prime metro customers, versus there are fintechs like us. Probably we are a little bit universal in nature. When I say that more than 75% of my customers are from non-metro residents, right? So we cater to mid-India, middle class and mid-income segments. So that's the segment what we cater to, right? So just to talk a little bit on the inclusion part, because in this particular segment where tier 2, tier 3 roughly is about like 50% of my customer base, most of them don't have a credit footprint on the bureaus, right? So, Saurabh is here, but we have at least taken customers more than 1 million, about 10 lakh customers who have come onto our platform, who are new to credit today, who have a bureau score. Now, these people have developed that bureau score starting their journey as a thin file on the platform, and now today they are a bankable customer, as in like they can go to the banks or they can go to any other lender to kind of take different sets of loan. Today on my platform, we don't do, let's say, the home loans, right? So, but definitely we have helped the people in their journey in building that credit score where he gets eligible to go for that particular home loan to a bank, right? So that's the inclusion part, what we take pride upon. And it's not just us. I think there are many other fintechs who have catered to that new to credit segment, right? So largely when we talk to the banks or somewhere the very traditional age-old NBFCs, if you ask one credit criteria, they would just say that, yeah, I will not give a credit to anybody who has a bureau score of, let's say, 750 or below, or 760 or below, or 730 or below. So the bureau penetration, which is there, probably 750 and above, is just about like, I don't know, it's just hardly about like 10% of the population in India, which has that one. So what should the rest 90% do then? What is about this 60, 70% of the population which are new to credit, right? So who are catering to that? So that space is largely filled today with the fintechs who have kind of become their first formal lender. And that's the inclusion part, what we also bring it together, and we have made a change. Personally, that's what gives me satisfaction, because more than 1 million guys have been transformed from a new to credit to having credible bureau score today on the KreditBee platform. And that keeps us going as well. Yeah, thank you.
Sure, Madhu. I think wonderful conversation. Thanks for shooting those questions. Unfortunately, I don't have enough time, else I would have still taken more questions. But quickly, one last question, and maybe just take 10 to 20 seconds. We have hardly 2 to 3 minutes left. Saurabh, I will start with you. What will make credit or digital lending successful going ahead?
I think partnerships, which is already something that is unique about the India FinTech model.
Sure.
And then I think better focus on underwriting and collections, which is also already starting to happen.
Sure. Souparno.
Yeah, I guess 2 parts. We are doing very well on tech. It's in the right journey. But we need to kind of work a little more on our biases. We spoke about underserved, the greater India, beyond tier 2. There are a lot of things in terms of consumer behavior, and sir, to your point around financial inclusion, is not just about credit, right? It's also about like other financial products. For us to demonstrate that courage, and the courage is not just fueled by technology, but to counter some of the biases which are there in our minds and possibly really understand the real India.
Rajat.
So I think 2 parts. One is collections, as Saurabh was saying. I think a lot needs to be done out there. And second part is the delinking between the credit and the lending business, which I started with. And I think if entrepreneurs can delink this aspect, are you providing credit as a service or you getting into the lending business? I think then it'll be much more clear and they'll be able to manage the credit cycles.
Sure. Madhu?
I guess the regulatory environment in India is evolving today, right? So therefore, sooner than later, that should reach to certain stability, which gives much larger round for further flourishing of the lending, credit, and fintech models.
Sure. Nitin.
Yeah, same thing. Predictable regulation. I think RBI is doing a lot of things, but just more predictability around regulation will clear up what one can do, what one cannot do.
Sure. Sanjay?
I would pick 2 as one is partnerships, and I think banks bring in deep funding and fintechs can bring in the ability to access. Second is we have to solve the problem of collections on the field, and I think probably the phygital model, whether we like it or not, it's not pure tech model, but a phygital where you have some physical presence will be there for at least some years going forward.
Sure. I think alliances, partnerships, collaborations, digital tech, I think all are these important partnerships and important segments which will make fintech successful. But I thought they will simply say recovery, which they didn't say. So please keep borrowing. Don't think about the recovery. But looking at the Merchant of Venice of Shakespeare, you could see that Shylock is dead, but flesh of pound is what I think will make the fintechs and the NBFCs or the people operating in credit space really successful, because it's not just about disbursing the loan seamlessly, but also collecting the loans seamlessly. That's where you will create a great ecosystem here. So thank you, ladies and gentlemen, for listening to me and the panelists very, very patiently. And thank you, everyone, for sharing your
One
insights
point, you
here.
can lend money also with us, not only.
Sure. Thank you so much.